Assalamualaikum and hi everyone, this is from Group 1 and the topic for our group project is inflation.
This is Group 1. We have SAFIA, MARYAM, AIMI, AISYAH and also ALLIYA.
Table of content. First, we have the definition. Second, the various degree of inflation. Third, the data from the World Bank. Fourth, two causes of the inflation. Fifth, who will stand to gain and lose during the inflation. Lastly, the effects of inflation.
Question A. Define inflation, deflation and also stagflation.
Inflation is a general rise in the price level in the economy over a period of time. Inflation is also a situation where there is too much money chasing too few goods. For example, food, clothing, housing, and transport. And when the general price level rises, each unit of currency buys fewer goods and services consequently. Inflation reflects the reductions in the purchasing power per unit of money. Inflation also can be contrasted with deflation, which occurs when the purchasing power of money increases and the price declines. Alright, so the opposite of inflation is deflation, which is a sustained decrease in the general price level of goods and services. Deflation usually happens when supply is high, demand is low, or when the money supply decreases or because of net capital outflow from the economy. And it can also occur due to much competition and too little market constructions. Meanwhile, stagflations, or we call it recessions inflations, is a situation in which the inflation rate is high, the economic growth rate slows, and the employment remains steadily high. It represents a dilemma for economic policy since actions intended to lower inflation may exacerbate unemployment. And then disinflation. Disinflation is a decrease in the rate of inflation, which means a slowdown in the rate of increase of the general price level of goods and services in a nation's gross domestic product over time. Disinflation occurs when the increase in the consumer price level slows down from the previous period when the prices were rising.
Next, we have various degrees of inflation. Creeping inflation, mild inflation and also hyperinflation.
What are various degrees of inflation? There are three various degrees of inflation: creeping inflation, mild inflation, and also hyperinflation. Creeping inflation is a sustained rise in price by about 20% per year. This causes consumers to expect price to continue rising, which boosts demand and consumers to buy now instead of later, when the product will likely be more expensive. High inflation is a sustained rise in price by about 8% to 10% per year. This inflation makes consumers expect price to continue rising. When prices are going up, people want to buy more now rather than pay more later. This increases demand in short term. Hyperinflation occurs when monthly prices rise by 50% to 60% or more. Hyperinflation is a term to describe rapid, excessive, and out-of-control general price increase in an economy.
Question C. With the help of the data from the World Bank, state the inflation rate in the consumer price in the annual percentage for the country of Malaysia, Pakistan and also Iran for the year of 2014 and also 2019. As what we can see from the data that has been provided by us, it shows that Malaysia inflation rate for 2014 is 3.14% with an annual change of 1.04%. Meanwhile, in Malaysia in 2019, it shows that the inflation rate is 0.66% with an annual change of negative 0.22%. Next, we have Pakistan. In the year of 2014, for Pakistan, inflation rate is 7.19% with an annual change of negative 0.5%. And in the year of 2019, it shows that 10.58% with an annual change of 5.50%. Last, we have Iran. The inflation rate for Iran is 16.61% with an annual change of negative 20.00% for the year of 2014. And for 2019, it shows that 39.91% with an annual change of 21.89%.
Next are the two causes of inflation, which are the demand pull inflation and the cost pull inflation. Cost pull inflation happens when there is an increase of price of goods due to the increase of the cost of production. Based on the diagram, if the aggregate supply shift upwards or to the left, the price level will increase and the real output will be decreasing. The factors of the shift can be due to a number of reasons. Firstly, wage pull inflation occurs due to the increase of wage level in society. So rising wages will push up prices as firms would have to pay higher costs to their workers, which results to a higher cost in output. Next, profit push inflation is a consequence of producers stocking up on their goods in order to increase the price of the products. The producers do this because of the desire for higher profits. Lastly, the import push inflation is a result of prices of imported raw materials or inputs increasing. So this is due to the fluctuations in the foreign exchange rate. Production costs will increase, resulting in an increase in the price of outputs, which causes inflation. The second cause of inflation is the demand pull inflation. Demand pull inflation occurs when the aggregate demand or AD exceeds aggregate supply or AS. A rise in AD may be caused by a numerous reasons like consumer demands, a rise in investment by firms, a demand in the country's export, or a rise in the level of government expenditure, or just a combination of the four. And based on the diagram, the aggregate demand curve have shifted to the right with the AS curve at constant or at a full employment output. So due to the shift of aggregate demand from AD0 to AD1 to AD2, there is a consequences of a rise in the equilibrium of the general price level from PO to P1 to P2. So in other words, a further shift of the aggregate demand AD will create a further price increase, which explains a demand pull inflation.
The next part of the slide is who will stand to gain and lose during inflation.
So firstly, distributions of income. Inflations change the existing pattern of distributions of income and wealth in society where some groups are relatively better off than others. There are two types of people which are affected by continuous inflations, which is the first one is people who stand to gain from continuous inflations, which are businessmen who earn higher profits from rising prices. Since the price of goods and services has been continuously increased, they receive many profits than usual. Secondly, property owners such as real estate owners who gain when property prices increase during inflations, shareholders who receive higher dividends and since companies' profits are higher, and lastly debtors because the real value of money has changed. So, the second type of people is people who tend to lose during inflation. Firstly, people who dependent on fixed income such as salaried workers and pensioners. Inflations may particularly harm workers in non-unionized jobs, where workers have less bargaining power to demand higher nominal wages to keep up with rising inflations. And then the second one, holders from government bonds, holders of fixed deposit in banks, and holders of life insurance policies and then money. And lastly, creditors, because when they receive the money owed to them, the real value of the money will be less. Inflation affects them especially hard because the prices of things they buy go up while their income stays the same. In addition, the poor are generally renters, so they don't even benefit from a cheaper mortgage while they are paying higher prices for their groceries. Now let's move on the effect of inflations from the perspective of distributions of income, savings, productions, and also balance of trade.
So next, the effects of inflation on savings. During inflation, the value of fixed deposits, bonds, life insurance policies, and money would depreciate in terms of real income, since the interest rate is fixed each year. This could cut your earnings. Real income is the purchasing power of money, which is measured by the quantity of goods and services that can be purchased with it. For example, you have 100 ringgit in your savings account that pays a 1% interest rate every year. Then after a year, you will have 101 ringgit in your account. But if at the time the rate of inflation is running at 2%, you would need 102 ringgit to have the same buying power that you started with. You may maybe gain a dollar, but you lost the buying power. Anytime your savings do not grow with the rate of inflation, you will effectively lose money. Uh, Since inflation depreciates the value of fixed deposits, people will save less and invest more in non-financial sectors such as land and houses. Not only that, but households also needs to spend more money to keep up with the increased standard of living due to inflation. Therefore, savings will also decrease due to the larger spending of households. Next is the effects of inflation on production. So during inflation, producers make higher profits since now price of goods and services increases. Therefore, producers will increase their productions and investment by utilizing all the available resources at their disposal. The increment of production and investment will create more job opportunities and reduce unemployment. But after the stage of full employment, the production cannot increase anymore since all the resources are fully utilized. Moreover, the producers will increase their stock of resources in the expectation of a rise in future prices that might increase their production costs, which any producers do not want this to happen. As a result, hoarding will increase. Lastly is the effects of inflation on balance of trade. Balance of trade can be defined as a nation's net exports. During inflation, the aggregate demand tends to increase because of higher incomes, greater production, and also larger spending. But the export trade is likely to suffer due to a rise in the prices of domestic goods. This increment of prices of the domestic products makes them less attractive to foreigners. Therefore, this leads to a reduction in the demand of domestic products and at the same time encourage imports since the imported products are now cheaper than domestic products. And when exports exceed imports, the nation has a trade surplus. And when imports exceed exports, the nation has a trade deficit. Therefore, inflation will lead to the nation to has a trade deficit since now imports are more than exports due to the increment of prices of domestic products.
That's all from us. Thank you.